First thing is that you understand what is the group structure. So sometimes you may have one parent, one subsidiary, one associate, probably one parent, two subsidiaries. Here it looks like that it's only about two companies. So it says that on 1st April 2008, Pedantic acquired 60%. So this is something you note, that it is 1st April 2008. So it's very important that your acquisition date is April 1st, 2008. And I don't move forward. I immediately see that financial statements are given to you for 30th September 2008. So you immediately, make some point in your mind that you are preparing financial statements for April, May, June, July, August, September. So it's a 6 months time period, which is called post-acquisition time period is 6 months. We acquired 60%, so it means that control is there. So we are going for 9.9 consolidation. Equity share capital of Sophistic in a share exchange of 2 shares in Pedantic for every 3 in Sophistic. So for every 3 shares we purchase in Sophistic, we give 2. So we are buying 60% of the shares. At that date, the retained earnings of Sophistic were 5 million. We need this number for calculating our net assets at acquisition, so that we calculate goodwill. The issue of shares has not yet been recorded by Pedantic. Now that's very important. Has not yet been recorded. So what does that mean? It means that Pedantic gave some shares to purchase Sophistic, but the new shares are not included in this 10,000. So this 10,000 is the old shares. So you issued new shares to acquire the business, and the issuance of those new shares, it is not appearing here. Okay. At the date of acquisition, shares in Pedantic had a market value of $6 each. So we will take $6 when we issue these shares of 2 in exchange of 3. We will use $6 this. And below are the summarized draft statement. You don't need to read all of that. Never make this mistake of start reading this thing. It does not make any sense. When you are doing balance sheet consolidation, the first thing you calculate is always goodwill. And goodwill means that we need consideration paid, which we can see from here, and we need net assets. These are the 2 things I'm very interested in the first point. I'm not going to, I may need to make 10 workings, but I don't think about the 10th working in the beginning. I think about the first working. The first working is goodwill. So I move down. Why do I not need it? Because this balance sheet is prepared on 30th September 2008. I am calculating goodwill on 1st April 2008. So on 1st April, this data is irrelevant. I don't need it at the moment. I go down. The following information is relevant. At the date of acquisition, the fair value of Sophistic assets were equal to the carrying amounts with the exception of an item of plant, which had a fair value 2 million in excess. We need it for net assets. If it had a remaining life of 5 years, we will do that. It is not needed in goodwill, but it will calculate the extra depreciation and it will decrease the retained earnings and the NCS stuff. Sophistic has not adjusted the carrying amount. Sales from Sophistic to Pedantic in the post-acquisition period. I don't need it because this is what happened between 1st April and 30th of September. I don't need it. It is going to impact, but later, not on the goodwill. Right now, I'm just making goodwill. Trade receivables, it is not the part which we need for goodwill. Pedantic has a policy of accounting for non-controlling interest at fair value. Yeah, this is what we need. The value of non-controlling interest in Sophistic at the date of acquisition was estimated to be 5.9 million. We need it. The current goodwill was not impaired. Okay, so this is the data which we have taken. Now what we are going to do, I'll just take this file on our Excel sheet so that we start working on that. Okay, in any case, I have to pick it up in 2 attempts. It will not go in one time. So one time I will take my first part. Allah, I'll take it here. And so this is first part of the question. I put it here. Let me make it a little bit smaller. And then we make the second part, which is the adjustments. And it starts from here to here. And now I tell you, I intend now to do 2 questions from balance sheet. Probably not today, but we need to do 2 questions from balance sheet, 2 from income statement, and then we'll do some past exam papers later. I'm going to finish this income statement and balance sheet in 2 lessons, and then we'll go to other topics and revision, and then when we will do past exam papers, we'll do it further. Okay. So who do we have here? We've got here Pamela, Ankit, Idris, and okay. Right. So we come here. Now the first thing which you need to prepare always is your balance is goodwill. In balance sheet consolidation, you always start with the goodwill part. And you know that goodwill, it comes with the first thing what you need to do is to calculate how much you have paid the consideration, right? So I would say like this, that my working number 1 is goodwill at acquisition, which is like consideration.
Yeah, we cannot see the Excel sheet.
I did not share the Excel. Okay.
No.
Is it there?
Yes.
Yeah, we can see it.
I just took all this question on Excel. Okay, we just put it here on transfer. So the first thing which you do is calculate the consideration which you have paid, and you know that your consideration is it went with the first thing was the share exchange. Okay, and you will do it in exam also like this. Okay, I'm putting here this thing, and here you put the calculation. So you should make this column a little bit wider because you show the formulas. So you are purchasing 60% of equity shares. Your equity shares in Sophistic are 4 million. So 4 million multiplied by 60% you are buying, and then how you are buying it? You are giving it 2 shares for every 3. It says share exchange of 2 shares in Pedantic for 3 shares in Sophistic. So 3 shares of Sophistic you are giving 2, and the share price is $6. So you should show like this. You take it here and you put equal to sign, and it comes the amount. So this is the share exchange value. And there is no cash, there is no contingent consideration, there is no deferred consideration. The question is quite simple. Then you have NCI at fair value. And if you see NCI at fair value, the value of NCI is 5.9 million. So I put here 5.9 million, and it makes a total of 15.5 million. Okay, so 15.5 million is the value of your consideration. You can call it your cost of investment. Then you see net assets at acquisition. So net assets at acquisition appear to be share capital. You can write down here from FS, which means from financial statements, which is 4,000. Then you have retained earnings. Also, you can say from FS, which is how much retained earning was how much? 5 million. They give you here 5 million, right?
Okay.
And then you have here your fair value adjustment. They increase your net assets. Your fair value adjustment was given somewhere here. So fair value adjustment means that the net assets of subsidiary were more, because I explained it before, I'm telling it again, that sometimes it happens that this subsidiary, the name which is called Sophistic, they are showing their on balance sheet, they are putting their assets at cost model, but parent is doing the fair value model. So the market value probably is 2 million more. On the balance sheet, you see 12.6 million, but maybe in the market it is 14.6 million. So fair value adjustment means that when you make a fair value adjustment, so essentially you are doing revaluation. And you know that revaluation means debit non-current asset and credit when you do fair value adjustment. So it increases. What is the impact? It increases the net assets at acquisition. Okay. It increases the consolidated assets in the balance sheet. It causes extra depreciation, and it decreases the subsidiary retained earnings. Did I explain the concept of fair value adjustment before? Yes or no?
Yes, you did.
We did. So fair value adjustment means that, you know, when Pedentic acquired Sophistic maybe is using cost model. You cannot tell Sophistic to change your accounting method. They will keep on showing it 12.6 million. But for the group is going to show 14.6 million. And when assets will increase, depreciation will increase. So in group accounting, you will increase the depreciation for Sophistic, which means Sophistic profit will be decreased. Because Sophistic is taking depreciation of 12.6 million, but you will add extra depreciation. And that is why they are telling you that which had a fair value of 2 million of its carrying amount, it had a remaining life of 5 years at that date, which means 2 million divided by 5. So 400,000 is annual depreciation. Sophistic has not adjusted the carrying amount in its plan. Okay. So now your fair value adjustment, it comes like 2 million. So it means that the net assets, you call it that your net assets at acquisition were 11 million. So if I have these numbers, I can say that goodwill is 15.5 minus 11. So your goodwill is in this case 4.5 million. It is done. The first thing is done. Next question. Usually the next adjustment which we need to do, that is for NCI you can do, and you can do retained earnings. So let's do retained earnings. So we will do retained earning table. Retained earning table would be our working number 2. Let me use the word working 2. And this is, we are going to calculate for parent and for subsidiary. So parent was Pedentic and subsidiary was Sophistic. And what you write down, your starting point always, you should say that as per financial statements. As per financial statements, you've got here retained earnings 35,400 and you have here 6,500. Why I am calculating retained earning? Can you tell me why I am calculating retained earning?
To calculate the goodwill.
No, goodwill you already have calculated.
Interesting.
Actually, I have to calculate NCI at reporting date. Okay, remember NCI at reporting date, and NCI at reporting date is equal to NCI at acquisition, which was 5.9 million, I think, if I'm not mistaken. It was given NCI at acquisition 5.9 million, and then you have to say that NCI's share in post acquisition retained earnings of Sophistic. So I need to calculate retained earnings so that I distribute that Sophistic retained earning between the parent and the NCI. That's why we are doing it. Okay, so if you don't make this working, you cannot make this also. So as per financial statement is 35,400, but this income, this profit is on which date? If you see that this 6.5 million is on 30th September 2008. When you acquired this company, how much retained earning it had already? How much it had? It had 5 million. So it means that the retained earning, which belongs to us or which we are interested, is always post acquisition. So you always say less pre-acquisition retained earning. So this 5 million we are subtracting. So it means that this is the value of retained earning, which we are talking about. This is something 6,500 is the total value of retained earning ever since Sophistic was created. All of that does not belong here because that has already been purchased. What we are talking about is the post-acquisition period, the period in which we became partners, the period when we purchased the company. So that is 15. But not only here, we need to make some adjustment as well. So usually you make adjustment here, extra depreciation. Extra depreciation. This is on fair value. If you see, I told you that on fair value, it decreases the subsidiary retained earning. So how much was the extra depreciation? You made a fair value of 2 million extra. It had a life of 5 years, right? And then 5 years life, it says that 5 years life, but you are talking about only, can I do like this? Do you allow me?
Yes, sir.
Why do I do it?
Because it's 6 months.
Yeah, because we are talking only about the 6 months period. So because we acquired the company on 1st of April and financial statements are on 30th of September. So our post-acquisition period is only 6 months. So it's a 6 months depreciation.
Okay.
Then you should always remember, and by the way, I will also send you the format also. There is one standard format which you can make if you want, you can make remember. So that form, like whenever you have to make this adjustment, there is always unrealized profit which must be subtracted. So unrealized profit will be there. If parent sold goods, you should subtract unrealized from the parent. If subsidiary sold goods, you should subtract from here. You remember we did it in last class when we were doing income statement, remember?
Yes, sir.
So let's see unrealized profit. How much is that? Sales from Sophistic to Pedentic in the post-acquisition period were 8 million. Sophistic made a markup on cost of 40% on these sales. Pedentic had sold 5.2 million of these goods by 30th September. So it means that what you have here, 8 million was there, total sold, 5.2 million it has sold. So now this is the remaining. I think it is 2.8 million is the remaining inventory. This is the closing inventory and multiplied by 40 divided by 140. This is the formula for 40% markup. So this is like 8 million minus 5.2 million. I calculated the closing inventory because 8 million it purchased, 5.2 it has already sold out. What is remaining is 2.8. So you can calculate here the unrealized profit. Now the question is that this unrealized profit, should I subtract it from Pedantic or Sophistic? Please read the question and tell me the answer. Who sold goods?
Sophistic.
Huh?
Sophistic sold the goods.
So we should put it here. We should put it here. Okay, now can I or should I do it like 6 months or 12 months or something like this? Do I need to do that? 6 months?
No.
Why?
No. Because
Yeah, because we are only talking about the closing inventory, whatever is remaining on the last week. So now when you make a total, you find out that this is 500. Now what do I call this 500? I will call it this 500. I will call it adjusted profit of Sophistic. Okay, this is Sophistic's adjusted profit. Now this 500 we are going to divide or distribute it between NCI and parent. And I will call it share of parent. So how much share we should give to parent? Parent purchased 60%, right?
60%, yes.
So 60%. So 60% of this 500 into this 60%, it should be transferred to the parent. So this I make a total and I call it here group retained earning at reporting date. Okay, so this 35,700 is group retained earning at reporting date. And then from this 500, something I should give here, NCI share in post action of retained earning. So I'll call it 500 into 40%.
40%.
So that is 500 into 0.4, 200. So this is my NCI at reporting date. So this is, I call it NCI at reporting date. This table which you prepared, retained earning table, this was very crucial and sometimes it is something which will create problem. Of course, F7 is simple, but still you need to do some practice. So now you know what is your NCI. So actually, if you see your notes, we are done with the note 1, we are done with note 2, we are done with note 4. Let's see note 3, what does it say? It says that Sophistic's trade receivables at 30th September include 600,000 due from Pedantic. Now you should remember that intra-group receivables are eliminated because there is a receivable for one party and there is a payable for one party. Let me tell you, let's suppose that this is Pedantic and let's suppose that this is Sophistic. And here you got receivables and you've got payables. So let's suppose that Pedantic receivables are 100 and Pedantic payables are 80. He got receivables of, I don't know, 50 and he has got payable of 30, something like this. But if I tell you that Pedantic, he has a receivable of $15 from Sophistic. So I create a situation. I say that Pedantic receivables include 15 from Sophistic. So this is called intra-group receivable. You should subtract it. It means that this $15 is included in this 100 of Pedantic receivable, and this $15 includes in this payable of Sophistic. So this 15 Pedantic is showing in receivable, Sophistic is showing in payable. So your receivable should be 100 plus 50 minus 50. So you take out that 50. And similarly in group payables, this is the group payable. Group receivable will be 80 plus 30 minus 50. So 15 you subtract from the total receivables and 15 you subtract from the total payables. Am I clear?
yes, sir.
Okay. So now it says that Sophistic's receivables at 30th September include 600,000 due from Pedantic, which did not agree with Pedantic's corresponding payable. Like here, payables are equal. Receivable payable, he says I have 15 receivable. He says, okay, no problem, I have 15 payable. But in this case, they do not match. Receivable payable are different. This was due to cash in transit of 200,000 from Pedantic to Sophistic. Because you know that during the year, Sophistic was selling goods to Pedantic. Sophistic sold goods. And Pedantic has paid some money through the bank, and that is called cash in transit, which means that when Pedantic made payment, he said, I made payment. So he decreased his receivable. He immediately said, debit bank credit receivable. Because for Pedantic, the payment was made, so Pedantic decreased its payable. But Sophistic has not yet received this money. Sophistic still says that I have 600,000 receivable. So how much is the payable shown by Pedantic, by the way? 400,000. Because Pedantic made 200,000 payment, but this payment will, it will land into the account after 2 days, maybe tomorrow, maybe day after tomorrow, in between the closing date comes in. So Sophistic, Pedantic, because he has already paid, so he will decrease its bank and decrease its payable. But Sophistic has not received it, so Sophistic balance sheet does not show the same amount. So we need to make this transaction. So let's go up and see where are the receivables. Now, do you see receivables here in the balance sheet? Do you see the receivables?
No, sir.
No. So where are those receivables?
There should be under current asset.
They should be under current assets. So let's make a working for current assets now. Let's make a working and let's call it working for and let's call it current assets working. So how does it work? So you've got here current assets of Pedantic, which is, let me see, 16,000 and the other one is 16.66. So I'll make it 16,000. And for Sophistic, it is 6,600. But these two numbers are not the final numbers. We have to match or subtract something. So first thing is that you will say that there is intra-company receivables. How much are those? Because within the Sophistic, he says 600,000. So you subtract 600,000, right?
100,000. Yeah.
And but you will add, you say cash in transit. Because what happened, that he's saying my current assets are 16,000. He did not include that 200 because 200 did not appear. So cash in transit you will add. Right? Do you understand this adjustment? Why I'm adding this?
Because P is the group parent.
Yeah, because what is happening that when one party made the payment, I'm actually, what is the intragroup balance by the way? Intragroup real balance will be only minus 400. So I should be actually, if you see the net effect is only 400 now. How much is the receivable? Please read this statement. It says that Sophistic has a trade receivable of 600,000, which did not agree. This was due to cash in transit of 200 from Pedantic to Sophistic. So actually Pedantic has already paid 200,000. So you should have here minus 400. The intragroup receivable is only now 400. But in order to make it, I should not show this one. One way is that I only write down minus 400. But in order to make it more clear, I write down here minus 600 and I say plus 200. That 200 cash will come in because this cash is not in the group. It is not recorded, so we add it back. Am I clear?
Yes, sir.
Yes, sir.
Okay, one more thing you should remember. You know this intra-group unrealized profit. How much was our unrealized profit?
Okay.
Minus 800, right?
Yes, sir.
This unrealized profit, you subtract it from two sides. You subtract it from the retained earnings and you also subtract it from the inventory. Because when Pedantic is showing its inventory, it is showing the inventory and you have to subtract here PUP. Because inventory is always shown at the cost to the group. Your PUP, let me make it here. Your PUP, unrealized profit, its double entry is debit, group retained earning, credit, group inventory. Group inventory is decreased always. So we should say debit group retained earning 800, credit is 800. On the balance sheet on one side, because you've got two sides of balance sheet. So on one side of the balance sheet, you are decreasing, on the credit side, you are decreasing the retained earning, and on the left side, you are decreasing the asset. Because when Pedantic is showing its inventory, it is including that profit which Sophistic made. So that means that its inventory had that unrealized profit. You have to decrease it, you have to take it away. Because the rule is that group inventory is always shown at cost to the group. At cost to the group. Did you people understand this point? If not, I will explain it again.
Please.
Yes. See here. Let's suppose that this is Pedantic and this is Sophistic. This is Pedantic, this is Sophistic. So what will happen? I say that Sophistic purchased goods for $100. Sophistic sold all the goods to Pedantic for $120. Pedantic has all of these in stock at year end. There is no other inventory in the group. There is no other inventory in the group. I'm just making it very simple, which means that Sophistic purchased something for 100, put profit of 20, and sold it for 120. And he sold these goods to Pedantic for 120. Now here you have inventory, your inventory balance here is 0. He does not have any other goods, and he has got inventory of 120. So individual financial statements, in individual financial statement, P will say that I have these goods, I purchased them from Sophistic for 120, this is my invoice. He is saying it correct because Pedantic, he actually purchased for 120. Pedantic purchased it for 120, so Pedantic can say that my inventory is 120. Sophistic does not have anything. But when you make your group inventory, you will say group inventory is 120 minus the $20 which is the unrealized profit. So group inventory will be shown at 100. Group cannot say at 120. Group will only show the inventory which was the cost to the group, and cost to the group was 100. So group inventory is shown at 100. Group inventory cannot be shown including the profits within the group, because if you talk about this 120, it has some profit within the group of $20. Do you understand my point?
Yes, sir.
So any unrealized profit on the group inventory, which is called unrealized profit, it is subtracted from the retained earning, just like we subtracted 800 from the retained earning, and it goes on the right side of the balance sheet, and we also subtract 800 from the inventory, the asset, it goes on the left side of the balance sheet. So balance sheet becomes equal. Subtracted 800 on both sides. You know, otherwise you will overestimate your balance sheets. You know, because maybe they both are companies and he sell to S, sell to P, P sell to S, S sell to P, P will sell to S. They will keep on selling to each other, and end of the year he will say my inventory is 500. Doesn't make sense. The cost of the good is measured at cost to the group, and cost to the group was 100. Because they both come under the same house. And when the goods came into this group area, it came at 100. So the cost when it came, it was 100. Cost is not 120. For Pedantic, cost is 120, but for the group, cost is 100. Pedantic will say it is 120, and he has a right to say 120. But group will say the cost is 100. So you make here, and this comes your current assets. Your current assets are 21,400, and I make it like this. Okay. So this is, I think we are in a position already to start our how to say balance sheet. So, but for making balance sheet, what I need to do, I need to bring down this stuff here somewhere, so that we will see it and we will make it, so that we don't scroll it again and again. Okay, because we need to see the balance sheet items here like this. So I will say consolidated statement of financial position for Pedantic group, and you know that first thing which comes is assets, and within assets the first thing you have is non-current assets. So how do we make the non-current assets? We have got here non-current assets is like, if you see property, plant and equipment, I will call it property, plant and equipment. You can call it PP and E. Once PP and E. So how much is that? 40,600 plus 12,600, the two of them, and plus 2,000. Can I do that plus 2,000? What is that?
Fair value.
Fair value adjustment. If you remember, I told you that the fair value adjustment here, fair value adjustment, it increases the consolidated assets in the balance sheet, because we said that subsidiary assets are not just 12,600, but there is 2 million addition. And I would say minus 200. What is this minus 200? This is the extra depreciation, because at the time of acquisition, the assets had 2 million value more, but in the next 6 months, you charge some depreciation. So this 2 million of fair value, actually, at the end of the year, it is only 1.8 million, because it has been depreciated. But I would prefer to write like this and write like this. Do you understand? So it's very simple. What you need to do, always remember, parent assets plus subsidiary assets plus fair value adjustment minus extra depreciation. That's all. And then what you come here, that's all in the balance sheet, because these balance sheets are individual financial statements. So you don't show goodwill. But when you make group thing, then you will show the goodwill. you have to show the goodwill. And how much is our goodwill? In group consolidation, we write down the goodwill, which is 4,500, 4.5 million. So I can say that the assets here are 59.5 million. And then I start writing down current assets. So how much are the current assets? If you remember from here, we calculated current assets, group current assets like this, and you should say from here, working number 4. So now you make a total of these two numbers. So 80,900,000, that I would say that total assets. It's done. 80.9 million. And then the other side of the balance sheet, you will write down equity and liabilities. So equity and liabilities, you write down share capital. And remember that when you make share capital, you only write down the share capital of the parent. You never write down share capital of the subsidiary. Why do you not write down? Because it is elimination, like item. On the asset side, you remove it from the investment, and on the balance sheet side, you remove it from the capital. So we remove the share capital thing. So we only have share capital of 10 million plus, I would say, 4,000 into 60% into 2 divided by 3. Can somebody tell me what does that mean? What I'm doing? Ankit?
Yes, sir.
What I'm doing here? What
So
is
you are
that?
calculating.
Because it told you in the very beginning of the question, it said you that you gave new shares of 2 shares in Pedentic for 3 in Sophistic, and it says that the issue of shares has not yet been recorded by Pedentic. So when Pedentic acquired, it has 10 million shares, but it gave some additional shares to Sophistic, but those are not recorded here. So what we purchased 60% of 4 million shares. So like 4 million into 60%. So we are buying 2.4 million shares in Sophistic. In Sophistic, we are purchasing 2.4 million shares, and 2.4 million divided by 3 multiplied by 3. And this is the new shares which we are giving, So in order to acquire 2.4 million, you actually are giving 1.6 million shares in Pedentic. So Pedentic number of shares will become now 11.6 million. Am I clear and clear? Because we purchased 60% of Sophistic, which means 60% of 4 million is 2.4 million. And for every 3 shares we purchased, we gave 2 shares. Now, remember, share capital is shown at $1, right? So it was $1 share. But what was the market value of the share? How did we calculate it? We calculated the share at $6, $6. So in the share capital, I'm only adding 1,600. I'm only writing 1,600 here. What was the value of share I gave? Please pay attention. What was the value of share we gave? Can you show? Do you see here?
Yes, sir.
How much is that?
9,600.
It is 9.6 million. The value of shares which you are giving, you took the value based on market, it is 9.6 million. But how much you are writing in your share capital only? 1.6 million, right? 1.6 million. Remaining is what?
Share premium.
Remaining is share premium. 1660 times 5. Because market value was 6, face value was 5, and the difference between face value and market value is called share premium. So students sometimes they miss here, because when you see the balance sheet, you do not see here share premium, so you don't write it. But actually, share premium will occur always. Whenever you will get a share exchange, never forget to think about share premium. And then you have retained earnings. So how much retained earnings should I write down here? How much are the retained earnings?
Parent plus parent share of subsidiary.
Yeah, so retained earning, I will not take this number because this is the retained earning of Pedentic. I have to find out the retained earning of the group, which was 35.7 million. We did it. We put it here. And I make a total here. And what do we call it? We give it a name. We call it equity attributable to the parent. This is for the parent. And then you have NCI. And how much is NCI now? So NCI at reporting date, you calculated here somewhere. This was your NCI at reporting date. So NCI, so some part of equity belongs to the parent, some equity belongs to the NCI. And then you write down your liabilities. What liabilities do you have? You've got here non-current liabilities, which are, how much you have non-current liabilities? There is no adjustment because they did not make any note for any adjustment. So I put here 7 million. So this is something liability. And then I have current liabilities. And how much will be the current liabilities? Can you tell me? 8,200 plus 4,700. And we need to make some adjustment. Minus 600, remember? In unrealized, the group receivable and payable, you have to subtract plus 200. This effect, which you make in your receivable, when you were making your receivables, where are your receivables? Current assets, you see, minus 6 plus 2. So this is the intragroup thing. So as it comes in the receivable thing, similarly, it would appear in your payable as well. The same thing, minus 600 plus 200. Intragroup receivable, intragroup payable, they are cancelled out. And you've got here 12.5 million. And now when I make a total, I make a total here this, plus this, plus this, plus this, then you get 80,900,000. You call it total equity and liabilities. Are we clear?
Wow.
Huh?
I have a question.
Yes, please ask. Now it is time for question answer session. We are not stopping here. Please ask.
Please explain the share premium.
Okay. The share premium is that when Pedentic purchased Sophistic, it did not pay cash. How did it pay? It gave shares, right?
Yes, yeah.
And how many shares it gave? So it was buying. So there was 4 million shares in Sophistic. So Sophistic share was 4 million. It purchased 60% of shares. So it means that you are purchasing, 4 million into 60%. So let me write down like this. Acquired. It acquires 2.4 million shares, but then it issues 2 by 3, which means that for every 3 share, you are issuing 2 new shares. So I divided with 3 multiplied by 2. So actually, he issued 1.6 million new shares, right? And he took the market value. He said market value is $6. So the 1.6 million share which is giving, we consider that the market value of that is 9.6. So we consider that our consideration, which was in form of share, the value of that consideration is 9.6 million. Now, when you ever issue shares, because it is issuing share, it is giving share to Sophistic and saying that, see, one share has a market value of $6. This is what is happening. You are Sophistic. I am Pedantic. I am purchasing your company. And I say, I will give you my shares. And I give you a piece of paper, which is called share. And I say, it has a value. I will consider it a value of $6. You say, on the share, it says $1. I say, but in market, it says $6. So in market, the share price is more. So whenever you issue more shares, your double entry is, you say debit, in this case, investment. Because you did not get cash, you say credit share capital, and you say credit share premium. And the rule is that in share capital, you can only write down the face value. In your investment, you consider it as 9.6. So the rule is that share capital, you will only show at the face value, $1. Any extra amount should be shown here in share premium account. So share premium account means that when shares are issued at a price more than the face value. So the extra thing is called premium. So we show it on share premium account here. Because 1.6 million we showed here. I already had 10 million. So 10 million plus 1.6 million, it becomes 11.6, and 8 million we show here.
Okay.
Because that was over and above the face value. That was extra than the face value.
Thank you.
Okay. Anybody else has a question, please? Ankit, Idris, there's one. No question, guys?
Sir, if there's a sale of non-current asset within the group, so what will be the effect of profit?
Yeah, we will get some question and we will do it. There will be profit which will be called unrealized profit. We will subtract it.
From inventory or from?
No, from assets they have been sold out.
Okay.
It is not inventory. So you have unrealized profit. That unrealized profit will be subtracted from retained earnings.
Okay.
You will decrease the value of the asset, just like inventory. You decrease the value of the asset and you decrease the retained earnings.
Okay.
Okay. Now, do you people want to do one more long question? We are, by the way, meeting tomorrow as well.
Yes, one more question.
We can do one more.
Yes.
Let me see which one we should pick up. Anyone we can pick up, makes no difference. So let's go in order. We do this 120. Okay. Do you people have F7 books?
Yes.
So please read this question of I will. I'll take a 5. We all can take a 5-10 minutes break. During this 10 minutes break, you can read the question. Make a proper reading so that we come back and we start again. It's a long question. Please pay attention to all of these adjustments. Okay.
Where is this question?
It is in your F7 practice kit.
Kaplan.
Kaplan or
No, this is DPT.
Okay.
Can
Question number?
Okay. I'm sorry. I've not shared. This is I will.
Okay.
This is I will. This is we just did 119, and now I move to 120, and it has many adjustments. You just read those adjustments. Okay.
Okay.
Please read the question.